I'd just like to welcome Michael Harvey to our monthly Ask the Accountant session. Thank you, Michael, for making the time. And as requested by us at the previous one, today is all about balance sheets. So I'm going to hand over to Michael.
All right, thanks very much, Hazel, and welcome everybody. All right, so understanding balance sheets. I'm presuming everyone can see my screen. Thumbs up, and we'll keep going. I was actually quite excited when someone requested this because in my accounting/finance career, I was drilled at a very early age to the actions in the balance sheet. Everyone sort of goes elsewhere and looks at other reports, but I always look at a company or business's balance sheet to get a feel and understanding for that particular business. So I always look at a balance sheet as a window. So it's a snapshot of that business at that point in time. So it's a window, and typically it's based at 30th of June every year. It doesn't have to be. Some businesses report on a more frequent basis and other reporting periods, but it's just that snapshot. At this point in time, this is what the balance sheet of that organisation looked like. Typically, it is three main financial reports that you would report on for a business. So you have the balance sheet, you have a profit and loss statement. I always treat the profit and loss statement as like a journey. So this is where the business has been over this period of time. Typically, it might be a 12-month period where you do a bit of a report to say what's happened in that, how much sales have we created, what's our gross profit, etc. But to me, it's not a window. It's a description of the journey that the business has been on. And then the other component, typically just to round off the financial reporting package, is a cash flow statement. And the common question people ask me is that where did my money go? And the cash flow statement is a report to show that this is how much you received, this is how much you paid out to the suppliers, this is how much you paid out for stock, equipment, and the like. So it answers that basic question. So just some terminology. So I grew up when everything was nice and simple with it's called a balance sheet, and that's still pretty much the common term today. Some academics got hold of it probably a decade or so ago and decided that a statement of financial position was technically more correct. So you will see that term being used, and technically that's the term that the accounting standards refer to, but I still call it a balance sheet. The other term that's used probably in more everyday language is a statement of assets and liabilities. And that is very, very similar. Probably tends to be used more when in a personal context. So if someone's going for a loan, then the bank will often ask, give me a statement of assets and liabilities, which is effectively a personal balance sheet. So a bit of what is a balance sheet made up of? So it's made up of assets. So something that you own is an asset. So something tangible, can be intangible, normally it's tangible, something that you own. Liabilities is something that you owe. So it's something that I might owe Darren some money for the exchange of goods. So that's a liability that I recognise. Another term I'll introduce called equity. And equity is purely the difference between the two. And then in a balance sheet is reconciled to say that equity or the difference is also the shareholders or owners' equity. But essentially that's so it's a loop arrangement. Assets minus liabilities equals equity is the maths equation of those of us who like maths. As I mentioned, there is I like it. Personal balance sheet's a great starting point because everyone's hopefully got a balance sheet of some form in their lives. So typically the average person might own a home, so that's an asset they have on their books, inverted commas, but personally. They'll have a bank account with some funds in it, hopefully. And then they'll have typically a home loan that they've got as a liability, mortgage against the property, and maybe a credit card with a limit or a debt. So that's sort of a typical personal balance sheet you might see. Then you do have equity in that situation as well. So often you'll hear people say, I've got equity in my home, which is really the difference between what the value of that home is worth, less what the bank, what you owe the bank. So then we look at, in the business context, what does a balance sheet consist of? So on the asset side of it, typically you might have accounts receivable or trade debtors, they're the same terms. So they're where you give credit to a customer, and they buy the goods off you, but you don't demand payment straight away. So that sits there as an asset. They owe you money. You'll have a bank account with some funds in it, hopefully. You'll buy some plant and equipment, motor vehicles, things like that. That's still an asset for your business. Some businesses will have stock on hand as well. So that could be physical stock, in terms of livestock, or goods that you make, or goods that you just buy in and repackage and sell. Then on the liability side of it, you'll have typically accounts payable. So that's trade creditors is another term, exactly the same. Where these are people that give you credit, where you go up to a supplier. So someone comes to me for my services. I don't demand payment on the day. So I'll say, yep, that's fine, Darren. I'll do that work for you, and I'll create an account, and then I'll bill you when the job's completed. So on Darren's books, that sits as an accounts payable, because I've given, he owes that money to me, but he hasn't paid it to me yet. Businesses will also have a business loan, or not always, but they may have a business loan, or an overdraft, or a combination of those. So that's typically what you might see on a business balance sheet. So I'll just quickly run through 3 examples. One is just to sort of flesh out a bit more of that personal balance sheet, because I think for me, it's a business balance sheet is just effectively an extension, and most people understand a personal balance sheet. So business balance sheet is just different terminology and some more assets and liabilities. So I'll look at that business balance sheet, and then I'll quickly touch upon three ratios you might want to look at when you're looking at a balance sheet. So I'll just see if I can come out of that and bring up the personal one. So, as I said, so this is some individual or a couple. They might have assets, so a bank account sits there as $5,000, a home of $500,000, might have investment property, 400K, say. So their total assets is $905,000. Then on the liabilities, they might have a credit card of a couple of thousand, a home loan debt, $350K as an example, and investment property loan of $300K. So liabilities are $652K. So their net asset position, their net wealth, if you want, is $253,000 in that personal balance sheet example. So that net asset is also, as I said before, that equates to equity. So when people say, what are you worth? What's your equity? That's the net asset position is one and the same. So banks often will look at this because they're 2 criteria they use, is basically what is your equity, personal equity. They look at that, and they look at your serviceability. So today we're looking at the equity position from a lending perspective, which is your personal and business balance sheets. So I'll just bring up the business one. Hopefully people can see that. So what you'll see is that, as I said, business balance sheet as at 30th of June 2020. We haven't reached it yet, so it's another week's time, but it's a window as at that point in time. Typically, you'll present a balance sheet as a previous period, and most times you present it as per the previous year. And then it's just broken down into assets and liabilities. What you do find with a business balance sheet is that things will get broken up between current and non-current assets and current and non-current liabilities. So the rule of thumb there is a current asset is an asset that you can convert into cash within the next 12 months. So obviously your bank account balance is already being converted into cash in the bank, and your accounts receivable or trade debtors, everyone's going to hopefully have their accounts receivable paid within the next 12 months. So they get typically classified as current assets. On this example here, we have got fixed assets, which is a sort of a subset of your non-current assets. So your fixed assets are typically your plant and equipment, your motor vehicles that have a long-term benefit to that business. So you have that benefit, as a rule of thumb, more than 12 months. So like a motor vehicle might have a life of say 4 or 5 years that the business is using it. So it's classified as a fixed asset or a non-current asset. A little bit of accounting jargon now comes in. So in the example on the screen, they've got motor vehicles 116,000 less accumulated depreciation. So what, from a pure accounting perspective, that allows you to depreciate, or in other words, amortise that particular cost over the effective life of that asset. So in a motor vehicle, as I said, might say you make the determination that's 5 years worth of value in that I turn my vehicles over every 5 years, and in a simple terms, that cost you would amortise or depreciate over that 5-year period. With most small businesses, we're probably driven by the tax rulings in this space, but from a pure accounting perspective, those costs get amortised over its effective useful life. So those of you who are in business and might have seen the instant asset write-off promotion that Harvey Norman and Ford Ranger and all those sort of guys are doing, what from a pure tax perspective, they're allowing you to get a tax deduction for that cost in the same year that you buy, even though from an accounting perspective it gets written off or depreciated over 5 years. So it's important, I suppose, that we don't lose sight of what the value of the balance sheet is in that process compared to what the tax rulings or tax promotions are on at that point in time. So larger businesses, what I tend to do is run 2 sets of asset values. So we'll have a tax depreciation and an accounting depreciation. Most 90% of my clients, we don't bother with that because, you know, it's not worth the extra effort. But from a pure accounting, financial perspective, having those 2 separate asset values or depreciation methods is what you would do. And as I said, in practice, most times we just write it off as per the tax ruling. On that example there as well, you've got another non-current asset. So in that case, it's borrowing costs. So there's some costs that you might have incurred when you took out a loan for the vehicle or something like that. And once again, it's another accounting principle called matching principles, where they say, okay, that loan lasted 5 years, that cost should be written off over the same period. So we have borrowing costs sitting on some balance sheets, some businesses. So the total assets of 165,000. In this example, current liabilities, GST, that would normally sit on a balance sheet because there are timing differences, because most businesses are effectively tax collectors for the tax office for GST. So they'll collect tax effectively by charging 1/11th on their produce, on their service or product. Then have an offsetting credit, and then pay the GST in the next quarterly BAS. If they've got employees, you might have PAYG withholding. Once again, that's a timing difference. So if you've got an employee, say they're on $1,000 a week, their gross, you take tax out at $200. So you accumulate that, and then once a quarter or once a month, you pay that to the tax office because you withhold that from their wages. And superannuation is another liability you typically see on a balance sheet, because once again, you accrue that liability, and not many people would pay that superannuation every time they do a pay run, but you accrue that liability. So the 9.5% on your employee wages, that sits there as a liability until you pay that either monthly or quarterly. So these, you get a sense there of what your current liabilities look like. They're short-term in nature. They come and go. There might be withholding elements from the tax office, and then you pay them back quarterly or monthly, but they're not long-term loans and debts. Then you have your non-current liabilities. So you have, these are the liabilities that will be with you more than 12 months. So in this example, it's come from a company. So the shareholder has actually lent money to the company. They might have needed some money for startup, whatever. So they've lent money into the company. So it's Westpac loan there as well. So they've got an external debt as well. So total liabilities of 86,000, net assets of 78,000. Just as an example, that's the equity position on this particular example. And I'll just quickly do up a ratio example. So here's three balance sheet ratios. So when you look at a balance sheet, these are the three examples I would probably look at 9 times out of 10. So you're looking at what they call a current ratio. So that's looking at current assets, so what you're going to collect or have collected within the next 12 months, and looking at your current liabilities, what you need to pay out. So rule of thumb, a current ratio, at least it needs to be greater than 1. You need to have more current assets that you can turn into cash than what you need to pay out. Otherwise, you call into question the solvency of that business. And I normally look for a ratio of at least 2 to 1. So you've got that cover in case you have any glitches down the track. So you can see an example I've put up there that the current ratio is very strong at 6 in the 2020 year and 10.1 in the 2019 year. So that's quite a good little litmus test just to look at what the balance sheet tells you there.
Michael,
Yep.
we just got a question from Chris. Chris, do you want to ask it, or I'll ask it actually, if that's all right? It'll probably be quicker. The value of fixed assets, does the value vary according to market value, or is the value the purchase value, and does that remain the same for every year? I see the accumulated depreciation. I'm assuming that is an amount that is calculated once and applied each year until the value of the asset is fully depreciated.
Yeah, so good question, Chris. So most small businesses, we just do it more on a simple basis. So it's just the cost of that particular asset, and then you just depreciate or amortize that cost over the say 5 years as an example for the effective life. Where I will vary it, if someone's going for a bank loan or are looking for raising equity or want to know what the true value of that business is worth, then we will recalculate the fixed asset values to be what the market value looks like. So from a tax perspective, it has no benefit, but from a evaluation of the business, then market value is very useful. And typically that will be probably 2 elements for businesses. So if it's got fixed assets of land and buildings or plant and equipment or whatever that are worth more than what we're writing the things off, then we'll revalue those. Then if you are looking to get equity in and to revalue the shares, if you want, if it's a company, then there are some intangible assets that might be recognised. Whether they're formally put on the balance sheet or not, sort of a discussion point around different accounting bodies and industries. So I'm talking about there where you've got sort of your own time and sweat and labour built into a business, and you want to get that recognised. If you want to sell your business, or you want to have an equity partner come in, then you'll typically revalue that and put an amount of goodwill, if you want, on the balance sheet as intangibles. But in terms of fixed assets, then you would revalue those if you were going for a loan, say. I've done that with clients if they've got a, say, land and buildings, which might be security in the business, then we'll revalue that if we're going for a loan with the bank. But good question, Chris. Hopefully I've answered that. Thumbs up. So just going back to the ratio, so the gearing ratio, and it's sort of, I was just thinking then, it sort of relates to Chris's question to some extent, because what the gearing ratio looks at is how heavily are you reliant on banking finance versus what you're providing for yourself in terms of your own equity. And it's sort of a risk profile of that particular business. So if you take the personal balance sheet example, then because it's a very tangible item for your home, then the banks might lend, say, 80% of the value, and you have 20% of the value from day one, and then you repay it back over time. Because businesses are a little bit more susceptible to up and downs, and they're not quite as tangible as a home, it's a composition of your debtors and creditors and stock and things like that, then we're looking for much more conservative debt to equity percentages. So in this example there, the only external debt was a Westpac loan, $32,000 in June 2020, and they had equity of $78,000. So in that calculation, it's external debt divided by your equity less the debt amount. So effectively your equity position before external debt. And so this one has a 30%. My figures are not right. I've plugged in the wrong numbers, and the 86% in June 19. That'll be setting off alarm bells for me. The 30% is a really good figure. So 30 to 50% is what I'd like to see within a gearing ratio on a small business. That shows to me that they're not overly reliant on bank debts, and you don't want to be in a position where some things might happen to a business and you're pretty much so heavily geared that the bank's after you pretty quickly. So it gives you some breathing space. And it does go back to Chris's point or question about your equity position would change if you revalued your assets to market, assuming your market values have increased. Another one, and the third one I've listed there is days debtors. The same principle would apply to someone who has stock on hand, that you're looking for the frequency of either someone paying you, or the stock on hand, the frequency that you are selling the goods. So the days debtors calculation is just your accounts receivable trade debtors balance as at that period in time, and then you work out what is your average billings per day, and then 1 divided by other gives you average days of how many days it takes for your debtor to pay you. So there's no sort of hard and fast rule that, but what you're looking at is comparing that number to your trade terms. So if I'm average days debtors in that example of 37, my payment terms are 14 days, I've got a real problem, because people are taking, another 23 days liberty of what my credit terms are. So that to me is alarm bells in that example. But if my terms are 30 days and 37, it's not as bad, because I've got some issues to work through, but people are paying within a week of what they should be, so it's not as bad. So if someone does have often the conversation is like, oh, I don't have enough money in the bank, but I'm making profit, and typically you'll find the cash is tied up in accounts receivable, debtors, or stock on hand. So they're the two elements I sort of track for those businesses that are relevant, that have accounts receivable. Some businesses are just more retail orientated. They don't run accounts receivable, and they just receive the money when people come into the store or whatever. But that's another little handy one that I sort of track in terms of looking at balance sheet ratios. That's about all I wanted to present on, I think, and just open for questions.
Okay, questions, anybody? Should we stop the screen sharing?
Stop the screen sharing, all right.
Yep.
Good point.
Just had a quick question, again, slightly related to Chris's, I guess, is how, I guess, highly volatile assets get reflected on a balance sheet. Say a company owns shares in another company, for example.
Yep.
Obviously, the purchase price very rarely, actually represents the value of those assets. Is that handled in the balance sheets in a clean way, or does that really require reassessment at an annual period?
Yeah, so you've probably got two types of investments. One is where they're listed, so it's I'd say on the ASX, therefore it's the market value is the best. You've got good data what the market value is.
Yeah.
Investments, say in private companies, say I invested in your company. It's you and I might have an understanding of what the value is worth, or we may not, and then how I'm able to present that on my balance sheet there's a lot more grey area, I suppose, and there's no hard and fast rule what that market is. I mean, if you look at the true definition of the market is where a willing buyer and willing seller exchange goods and services.
Yeah.
So if I buy 10% of your company, that's a willing buyer, willing seller. So therefore, we've set our own market price. Therefore, we use that cost price as what sits on my balance sheet, but in 5 years' time, with no other transactions, what's that market value worth? Unless we go and test the market, or if you are wanting to sell that business, then you'll typically do a business valuation method, which is, to me, is a modified version of the balance sheet. You just go through the balance sheet and reconstitute. Okay, Darren's business, I had 10%. What's it worth today? And also, when you buy in, I suppose there's just a little transactional. So sometimes I'll buy the shares in your business, in which case I get the percentage of the debtors and creditors and the percentage of the whole balance sheet. And other times I might just want your business assets. So I just want you. So I don't actually buy that, but I buy the business assets. That's a completely different transaction then, because I'm actually not buying your balance sheet. I'm just buying what you can bring to my business.
Okay.
There are some benchmarks that you can get. They tend to be more on the profitability aspects, such as I know the tax office put out some benchmarks a few years ago. They were a bit too high level and non-industry specific for me. But I suppose what I've gleaned, say, look at the balance sheet, is probably trying to unpack how a banker's brain works. Just when you get feedback, when you put up a client's financials and they, how they pull it apart, because they'll look at that gearing ratio, for example, and then they'll adjust what they think the market value is worth, and they'll just say, well, I don't know, that's not worth anything to us, so we won't take that into account on the asset side of it. That's why you look at, say, the gearing ratio of 30 to 50%. That's just what I've sort of gleaned over time. What banks look at, I suppose.
There we go. Yes, too many screens. Just a quick question going back to the business balance sheet example you had there. The loan costs that you had as an asset that was then appreciated over the period. I think that's one thing that people often find slightly confusing, in the fact it's a cost. So how is it an asset? Is it because it's effectively viewed as a loan of that cost over that period of time, and hence it's being written off over that 5 years or whatever?
Yeah.
I think that, so it's that difference.
So it's sort of, I suppose, where accountants can make things probably a bit more overcomplicated than what they should be, but essentially it's a cost of getting that loan. And so the theory is that you then amortise that cost over the period that you've taken the loan for, under that sort of matching principle, that you've got costs matching up to the length of either the life of the asset or the length of the borrowing.
Sure. Okay.
But that's an example where the banks will just put a line through it, so it's not an asset. We don't recognise it. So.
Yes, I think that's often the confusion. Is something I used to find years ago is things that you look at and go, actually that's actually a liability. How's that being listed as an asset? And as you say, it's sort of, the old accruals thing catches you again. Yeah.
We've got a question. Is so equity is equal to net assets? Question mark.
That's correct. Yep. So assets minus liabilities is your net assets is the same as equity. So your equity can come in two forms. One is effectively, from a company structure perspective, would be the value of the shares that's issued to shareholders, as well as the profits that are reinvested back in the business. So for a sole trader, they don't have shares as such, so their equity position is just their accumulated profits that they haven't pulled out of the business and are reinvesting back in the business all the time. So then people go, okay, why don't I have all that money that I've reinvested back in my bank account? And that's where the balance sheet, to me, is just such a great example, where you say, well, you've got other assets, you've got stock on hand, you've got debtors, you've bought plant and equipment, but then you've had support from your trade creditors and you've had support from your bank and stuff like that. So some of it's been supported by other parties, and others portion has been supported by yourself with equity.